Should you use the S&P 500 or 60/40 stock bonds for comparing system performance? This is Bill Scheid from Applied Finance Research, and that's the question we're going to look at in this video. If you've been around for a while, you know that often we tend to compare our system performance with two different metrics. On the left-hand column, we have the performance for the S&P buy and hold over the length of this backtest period, which happens to be from December of 2007. And the second column is the performance of a 60/40 all-world stock and bond buy and hold portfolio. So the question is, when you're comparing the performance of a system that you're researching, should you compare it with the S&P 500 buy and hold or 60/40 buy and hold? To make a long story short, it really has to do with your individual preference as a trader and an investor and the objectives that you are trying to accomplish. At the end of the day, there is no right or wrong, but there are pros and cons for both. So let's talk a little bit about some of the subtleties. So often people like to compare their performance to, quote, the market, and typically for many traders and investors, professional traders and investors, the S&P 500 is our proxy for the market. So because people like to say I beat the market or I didn't beat the market, et cetera, the S&P 500 can be a popular choice for comparing system results. Now, the downside to that, or one of the cons, is that it may not be practical or realistic, in the sense that most traders and investors, especially retail investors, are not going to just simply buy and hold the S&P 500. That would come with quite a lot of volatility. As we see here, the maximum drawdown for the S&P 500 is minus 52.3, which would, I think, give many retail investors a heart attack and probably just blow them out of the water in terms of being able to stick to an investing plan. So it may be more realistic to think along the lines of 60/40 buy and hold. 60/40 has kind of been a popular mix of stocks and bonds in the retail investment world, and so it may be more reflective of the actual performance you would get if you chose to not go with the system that you are researching and actually do buy and hold. And the reason that 60/40 I think is perhaps more realistic or closer to what many retail buy and hold investors would accomplish is because the maximum drawdown is lower at minus 34.7. Now, if you've ever lived through a 35% maximum drawdown, you know that that is a pretty steep maximum drawdown, and you have to have a good level of psychological preparation for that, or have a really good financial advisor who is very good at convincing you not to change your buy and hold approach. Now, of course, with that reduced maximum drawdown also comes a reduced total return. So in many cases, when you're designing a system, when you're researching a system, it's easier to beat the return of 60/40 buy and hold, and it's easier to beat the maximum drawdown of the S&P 500. I think compounded annual growth rate and return to drawdown ratio are also two important metrics. And again, this would come down to your objectives. How much do you need to make over what period of time to meet your financial objectives for the system you're considering running? And I really like return to drawdown ratio because I think it's a quick and easy metric to determine how much reward are we getting versus how much risk are we taking. Now, I did say earlier that it's easier to beat the buy and hold return and easier to beat the S&P buy and hold maximum drawdown. You will notice that BMR 21 and BMR 21 with sober, this is without shorts by the way, they beat both of these systems on both of those metrics. So BMR 21, we have a return of 693 versus 323, and we have a maximum drawdown that's just slightly less than that of 60/40 buy and hold. And of course, that comes out to bear in the return to drawdown ratio. So for me, when I see a system that outperforms the return of the S&P by, a factor of more than 2, and it has much less drawdown, or it does that on the drawdown of 60-40 buy and hold, to me, I really like to see that performance personally as a trader and an investor. And then when we add sober, wow, the numbers really jump up. So now we're getting not quite 3 times the return of S&P on half of the drawdown of 60-40 buy and hold. So again, to answer the original question, should you compare with S&P or should you compare with 60-40? There is no right or wrong. It really has to do with what's practical and realistic for you as an investor and what makes sense in terms of the objectives that you're going for. For me personally, I do also like to take a look at the ending balance. I think it's pretty sobering, and it brings things back to where the tires hit the road. Ending balance for me, I start with 100,000 in a hypothetical account, and I just grow it at the compounded annual growth rate for the period of the back test. And I do like to see these numbers because, of course, it just tells us, hey, well, what would be the difference in dollars if I chose one of these approaches or one of these systems versus the other. And then, of course, being a student of Dr. Van Tharp and Dr. Ken Long, I like to look at expectancy and SQN and ask myself, what would Van Tharp say about the system that we are talking about? Of course, we could also calculate expectancy and SQN for S&P buy and hold and 60-40 buy and hold. I just didn't include that in these data here. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.